Hey everybody, welcome back to 5 Minute Financial Markets. Well, for the first time really ever, the S&P 500 closed above this downward trending line that has held it down since all the way back in January of last year. Again, this was the all-time high. It rejected off of there, hit this line again in March, rejected off, hit this line again in August, rejected off, hit it at the end of November, middle of December, rejected back down, hit it a few days ago and rejected back down, but this is the first time that it's actually closed above this line. So let's take a closer look and see what's going on and where will the market head from here. Taking a closer look, we opened up higher today using the 200-day moving average as support. So it went up a little more than 1.5% at the high of the day, came down to up about 1%, and then rallied into the close to close up 1.2%. There's a lot of bullish momentum forming these last 2 days, as you can see down here in the RSI. So where do we go from here? Well, I think there are three likely scenarios. The first scenario, which I'll say is about a 40% likelihood, is that we just reject back down tomorrow, get back under this channel, and this is another false breakout just like we had here, here, and here. I think the more likely scenario, which I'll also put around 40%, is one where we confirm above this line tomorrow, and then eventually over the next few days to maybe week and a half, we come back and retest this line, at which point we really decide if this line is going to be supportive or if we're going to break back down. If it bounces off this line and heads higher, that's a very bullish sign for the medium term. If it breaks down lower, that's a very bearish sign. But this type of breakout and then come back and retest pattern is very, very common, especially when we've broken through a level of resistance that's been very strong for such a long time. The market very rarely will just keep going forward. It'll often come back and retest and then either bounce off or reject back lower. If we do come back and retest and find support there and come back off, that's a very good sign for bullish movement into the next several weeks or maybe even a couple months. The third scenario, which I think is the least likely at around 20%, but definitely possible, is that we just continue to melt higher, that the short interest is going to get squeezed and people will have to liquidate their short positions, which will push this higher and higher at a rapid rate. We could get up to this previous high back here in December of 410, maybe even back up to this 420 range, and possibly even beyond if there's enough momentum and enough FOMO or fear of missing out on this big market move. If it does go that way, I will be very, very wary of the strength of this market. The fact that it never came back to retest this and just ripped higher shows a lot of FOMO, a lot of emotion in the market, and that is not sustainable. And that is likely a setup for a major crash later this year. So to review, scenario one, we reject back down, come back under this line and chop around here for a little more before the next big move. Number two, we stay out above this line for a few days, come back to retest, and then ultimately make our decision to go higher or break back lower. Or number three, we just rip higher, in which case look out below when this crash comes because it will come down hard. So can we find any clues that'll tell us which of those three scenarios is the most likely? Well, I always like to look at the divergences. When you see divergences, it tells you that the market may not be what it appears. So we have a slight divergence here on the S&P daily with its own RSI or momentum indicator. So here we have a higher high on the S&P itself, but a lower high, very, very slightly lower high on the RSI over that same time period. That's a very subtle divergence, but typically when you get a move up with momentum coming along with it, that tells you that there's strength to this rally. The fact that it's not doing that is a little bit of a sign of weakness. An even stronger divergence is this one here, the smart money versus dumb money indicator. Dumb money being the S&P, smart money being the bond market, or HYG. Looking at the hourly chart, we've got a higher high on the S&P since January 18th up until today. Over that same period, we've got a significantly lower high on the HYG. That tells you that the bond market is not coming along for the ride on this. The bond market is skeptical of this rally, and when there's a divergence between the smart money and the dumb money, between the stock market and the bond market, trust the bond market. The bond market generally knows better. Finally, let's look at the US dollar, which has an inverse correlation to equities or the S&P. So as the dollar has moved down since the middle of November, all the way down in this channel, the equities market has gotten stronger, but we do see a divergence forming here as well. Lower lows on the US dollar, slightly higher lows on the US dollar momentum indicator. So that's another very subtle divergence, but it is a divergence, and it shows that this downward momentum with the US dollar is running out of steam and could very well be curling up in the near future. An upswing in the dollar is bad news for stocks and means that equities would head lower. It is very interesting times in the market right now, but also very dangerous times. Be very careful out there, practice good risk management, have your stops in place, and we'll see you next time. Thanks for watching.